Now let's discuss the dissolution of a partnership. The dissolution of a partnership means the partnership changes but continues to operate as a business. Remember, when we liquidated, that's when we cease to operate as a business, but a dissolution means that one partnership dissolves and a new one is formed. This occurs when we have the admission of a new partner. So we're going to go in and we're going to admit a new partner. So admission of a new partner, or the withdrawal of an old partner or existing partner. So an existing partner withdraws. All right, so that's our possibilities of why we would have a dissolution. What happens in that case is the old partnership agreement has to be discarded, and a new partnership agreement must be formed between the new partners, or the partners that are remaining in the firm. This situation must properly be accounted for in the accounting records anytime we have an admission or withdrawal. So let's look at an example of a partnership dissolution by the admission of a new partner first. The Parker Moss Company, a partnership, decides to admit Greenwall as a new partner on March 1st, 2014. The company's balance sheet shows Parker capital of $30,000 and Moss capital of $50,000 at the time of the new partner's admission. Income and losses are currently shared by Parker and Moss at a ratio of 3:2. Prepare the journal entry to admit Greenwall to the partnership under the following independent situations. All right, so each of these are different possibilities of how Greenwald could come into our partnership. So the first one says Greenwald pays Moss $15,000 for 20% of Moss's interest. So in this example, what's happening is the new partner that's coming in is simply buying a portion of the existing partner's ownership. In this case, the only thing that happens here is a movement of capital. Remember, we're only concerned with accounting for the partnership. We're not worried about what happens to the personal accounts of our partners. So Greenwald is paying out of his personal account into Moss's personal account. That's money that's outside the scope of the partnership. The only thing that's inside of the scope of the partnership is this 20% of Moss's capital, or Moss's interest. So what we need to do is first find out how much interest does Moss have. So Moss has a total of $50,000 in the capital account. So what we'd want to do is take that $50,000 and we're going to multiply it by the portion they're giving up, 20%. So when you do that, you get $10,000. So basically, Moss is giving up $10,000 of interest, and that interest is going to Greenwald. Well, how is Moss going to give that up on the books? Well, Moss has 50. Remember, that's a positive 50, so that's a credit balance. So in order to reduce that by the 10 they're giving up, we need to debit Moss capital. And we need to debit that Moss capital for a total of $10,000, the amount we're removing. Now, where's that $10,000 going? Well, it's still capital, but it's moving from Moss over to Greenwald capital. So Greenwald is going to get increased by 10. So anytime one partner purchases the ownership of another, all that moves is capital. The cash is outside the scope of the partnership because the cash moves between Greenwald and Moss, not between the partnership and Greenwald. Okay? So be careful with that. All right, so that's one possibility. Let's look at the next possibility. Well, what if? What if Greenwald invests $20,000 in the partnership for 30% ownership in the partnership? Okay, so we've got the same thing going on here. Greenwald's coming in as a partner. However, in this instance, Greenwald isn't paying another partner. It's actually it's investing into the partnership as a whole. So if the new partner is actually investing money into the partnership, that cash has to be recorded into the partnership's cash account. So in essence, this investment of $20,000 is going to bring up the partnership cash. So we need to debit that cash for $20,000. Now, why is our cash going up by $20,000? Well, our cash is going up by $20,000 because we're adding this new partner and we're adding Greenwald. So that means Greenwald needs some ownership here. Well, how much ownership does Greenwald need to get? Well, notice it says that he's getting, or she's getting, 30% ownership in the total partnership. So the first thing we need to figure out is, well, how much is 30% of the ownership? Well, what's the total ownership? Well, the total ownership is the total capital structure of the company. So remember, we had $30,000 in capital for Parker. We had $50,000 in capital for Moss. Now, that's the pre-existing capital structure. When an owner invests, guess where that has to go? Owner investments is capital as well. So we need to make sure that we include that owner's additional investment of 20,000. So we're going to take that 30 plus that 50 plus that 20, and that brings us to 100,000 in total ownership of the company. That's our total owner claim against the assets is 100,000. Now, how much of that ownership is Greenwald going to walk away with? Well, he is getting 30% or 0.3. So we're going to take that 100,000 times the 30%. That's going to give us $30,000. So Greenwald is paying in an investment of 20,000 and only is receiving an investment amount of 30,000 into his capital. So what does that mean to us? Well, that means that they're really wanting Greenwald in. They're allowing him to buy in at less than they're giving him. The problem is the capital structure has to remain at a total of 100,000. So in order for this capital structure to remain at 100,000, our other pre-existing partners are going to have to pay a bonus to Greenwald. In other words, they're giving up a portion of their capital to put it into his account. So that means their capital is going to go down. So we're going to have to reduce Parker's capital, and we're going to have to reduce Moss's capital by some amount, because they're giving up a little bit of their ownership in order to get Greenwald to come into the partnership. Now, how much? Well, when we get to this point, what we have to look at is the ratio. The pre-existing ratio was a Parker and Moss at 3-to-2 ratio. So that means Parker's going to give up 3/5 and Moss will give up 2/5. So what we'll need to do is take that difference. Now notice he paid 20, we gave him 30. So that means there's 10,000 in bonus that needs to be allocated out. Well, who's going to give up what? So you take that 10,000 and you multiply it by 3/5. And when we do that, you should see that we're going to give up $6,000 from Parker's capital. And then we're going to do the same thing. We're going to take that 10,000 and we're going to multiply it by 2/5 in order to figure out Moss's. So when we do that, we see that Moss is giving up 4,000, okay? There again, they're paying this bonus out. They're paying it to that new member. So they're willing to give up a little bit of their ownership to bring Greenwald in on board, and he's only paying in 20,000 for a total ownership of 30,000. So that's one possibility. All right, moving on. What if Greenwald invests 20,000 for 10% ownership in the partnership? Again, we ignore A and B happen. We ignore 1 and 2. We're going straight for what if this scenario occurred. Well, pause the video and see if you can come up with the entry for this one. Now that we've done the number 2 there where you saw how to allocate, pause this, see if you can come up with the answer for number 3. All right, well, let's see what you got. Well, first and foremost, we know again that Greenwald is investing money and it's coming straight into the partnership. So we need to take into account that 20,000 in cash is being infused into our partnership accounts, okay? Now, why is that happening? Well, that's because we've got this new partner, Greenwald, and we know we're going to have to give Greenwald some of this ownership that he's investing into. So we need to credit his account. Well, how much do we need to credit the account for? Well, let's find out. What we need to do is go in again and find the total ownership structure. Well, again, it started out with 30,000 for Parker plus the 50,000 for Moss. Now again, he's only investing 20,000, so that's going to come in again at a total ownership of 100,000. Then we multiply that by the 10% ownership that he's receiving, and he's only getting $10,000 in capital. So that's his ownership structure. Now wait a minute, he is paying more money into the firm than he is receiving. So what's happening there is he's actually giving the other members of the firm a bonus, because again the total capital structure has to maintain at 100,000. We've got 20,000 coming in, but only 10,000 of that owner investment being allocated. So the remainder is going to go to our partners. And again, this is going to be a bonus to Parker and Moss. So Parker is going to get a little bit of a boost, so to speak, in his capital, as well as Moss into her capital. All right, now how much? Again, the pre-existing ratio was 3-to-2. So Parker's going to get 3/5, which again, that 10,000 difference is going to be 6,000, and Moss would get 4,000. Again, that would be calculated the same way, because if you notice, The 20 to 10 difference is still $10,000. So that's the amount, that $10,000, the difference between 20,000 cash and the 10,000 ownership. That $10,000 difference needs to be allocated out. So it just happens to work out 3/5 is 6,000, 2/5 is 4,000. All right. So that's how we could possibly admit a partner. Either one partner buys out, or excuse me, either the new partner buys a portion of an existing partner, or that partner invests straight into the partnership for a return or for an ownership percentage. All right, now let's change gears a little bit and let's talk about withdrawals. What happens when a partner decides to go in and withdraw from an existing partnership? So the Moss, Parker, and Greenwald Company, a partnership, balance sheet shows Moss capital of 50, Parker capital of 30, and Greenwald capital of 20 as of July 1st, 2014. Moss, Parker, and Greenwald currently share income and losses at a ratio of 4 to 4 to 2 respectively. On July 1st, 2014, Greenwald withdraws from the partnership. Record the journal for the withdrawal under each of the following independent situations. Now, if you were taking this as a flow of information from the last problem, he didn't make it very long in our partnership, but that's not what it's supposed to be. It's just an example. All right, so again, what's happening here? Well, one, Moss and Parker agree to pay Greenwald $15,000 each for 50% of his ownership. Now, again, when we look at this, we have to ask ourselves, cash movement, who's paying who? Well, in this case, Moss and Parker are paying Greenwald, which simply means it is coming out of their ownership, and that's supposed to be, I do believe, $15,000. So they're each paying $15,000 in ownership there. Or they're each paying him $15,000 in order to get 50% of his ownership. Again, in that instance, the cash is moving outside the scope of the partnership, so we do not need to record the actual cash movement. We only need to record the movement in capital. So what's happening to capital? Well, remember, Greenwald is leaving, and if Greenwald is leaving, his capital needs to completely go away. And he had $20,000, and to get rid of capital, remember, we're removing capital from our books, we need to debit that account. Well, what's happening on the offset of that? Again, this is a movement of capital, and they agree that Moss and Parker will each get 50%. So we just need to take that $20,000 and we're going to split it between our existing partners. So Parker Capital is going to get an increase, and Moss Capital will get an increase, each of 50% of that actual capital balance. Okay? Now let's look at a slightly different scenario. Again, up here it was just a movement of capital because the partners were paying. But what if the partnership ends up paying? So in part 2, the partnership agrees to pay Greenwald $30,000 cash for his interest. So now we have to really be careful because the partnership is paying cash. So when we're accounting for it, we have to make sure that we take the cash out of the partnership. Well, we're paying out, so our cash is going to go down. So let's go ahead and do that. We know we're going to have to credit out our cash, and we have to credit that cash out at $30,000, the amount we're actually paying Greenwald. Now, why are we paying Greenwald? Well, Greenwald is leaving our firm. So remember, when we look back, Greenwald had capital of $20,000. So if he is leaving, we need to remove that capital. We need to take him completely off of our books. So Greenwald capital needs to come out. And in order to remove capital, we need to debit that account. So we're going to remove him from the firm at $20,000. So what's happening here? Well, we're paying him more than he's worth. So we're basically giving him a bonus. Now, we're reducing asset because of owner withdrawal, this $30,000. So the capitals have to go down. Well, Greenwald, the most we can take his capital down by is by the 20 that he has. So that means that our other partners have to pay out of their capital in order to meet this $10,000 difference. So notice, he's getting 30, he only has 20. That's a $10,000 bonus that we're paying to Greenwald in that case. So that actually has to come out of the other members' capital. So it's going to come out of Parker capital, and it's going to come out of Moss's capital. It has to be pulled out. The question becomes, well, how much comes from each? Well, again, remember, let's go back here and look. What was our ratio of this partnership? Our ratio was a 4 to 4 to 2. So what that means is Parker gets 4 tenths, and Moss gets 4 tenths, and Greenwald got 2 tenths. Well, when the partner removes, though, we have to get rid of that partnership's portion. So notice it was, again, a 4 to 4 to 2. Okay? So 4 to 4 to 2 there. That's Parker, Moss, Greenwald. Well, remember, Greenwald is leaving our firm. So if he's leaving, we need to X him out. We need to back off that too. So what does that leave us with? Well, that leaves us with a 4 to 4 ratio going on there. So that's what we have to look at, is a 4 to 4 ratio. So 4/8 is what that becomes. 4/8 will go to Parker and 4/8 will go to Moss. So again, take that difference, 10,000 times our 4/8. And again, I know you can probably convert that in your mind that your 4 over your 8 is actually what? 50%, right? So that's same as 1/2. But anyway, in the scheme of things, I didn't really pay attention to that when I was creating this. It shows you that that third member's partner, Greenwald, that's leaving, that ratio needs to be changed because he's no longer there. Now we have to stick with the original portion though until we redraw our partnership agreement. So it leaves us with that 4 to 4 ratio, which is 4/8 to 4/8, which is half and half or 50-50. All right. So that means that Parker's going to get the 5,000, and then that 10,000 times 4/8 again, which is 1/2 for our Moss, would also be 5,000. So each of them is going to get 5,000 of this actual bonus. And that's going to reduce their capital. So they're paying out a little bit of their capital to give the exiting member a little bit of a bonus. Okay? So now that you know how to do that, pause the recording and see if you can come up with this third scenario. In the third scenario, the partnership agrees to pay Greenwald $15,000 cash for his interest. So spend just a moment and see if you can come up with the answer. So go ahead and hit pause and see if you can come up with that. All right. Hopefully you hit pause because I'm not going to sit here for 5 minutes on a recording and wait on you. But anyway, you pause that, you worked it, and let's see what you come up with. Well, again, I'm a big fan of doing what I understand first, and I know that Greenwald's leaving. Greenwald is leaving us. We need to strip out his capital, and I know that he had capital of $20,000. Then what else do I know for a fact? Well, I know that we are spending money. Our partnership agrees to pay. So this money is coming out of our partnership. And our partnership was okay that to pay him $5,000 for him to exit the partnership. Now, in this case, we are paying Greenwald less than his ownership is actually worth. I get the question all the time, why would he take that? Well, there's several different reasons. Maybe he's just not performing and he sees it as a way out. There's several different reasons they would. The company's sort of not doing as well as it should be, and he's pulling out. There's several reasons why that may happen. I've always heard people say, well, I wouldn't take less than my part. Well, that's not necessarily true. It really would depend on the situation you're in. So he is receiving less. So what happens there? Well, remember, the capital has to remain constant. It has to be a 20-20 here. 20,000 is going out. There has to be 20,000 somewhere else to offset that. So where's that going to be? Well, in this case, Greenwald is going to pay a bonus to the other members in order to leave the firm. So that means we're going to take it from Greenwald's account and we're actually going to put it into our other partners. We're going to increase their capital by some percent. Well, again, remember what the ratio was. It was 4 to 4 to 2. And when you have that 4 to 4 to 2 ratio, you have to go in and say, okay, the difference there is 5,000. So let's just go back up here and look at this. The difference is 5,000. So we would do the 5,000 again times the 4/8 because Greenwald's the one's leaving. That's leaving us a 4 to 4 ratio. 4/8, again, I understand that 4/8 is 1/2 or 50%. So that means that each of our members are going to get a $2,500 bonus into their capital. And that keeps us in balance. All right, so hopefully in watching this, you understand a little bit more about a dissolution, how we go about admitting a new partner or withdrawing an existing partner.